You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you.
Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody, that music means we are back. It is time once again for a little bit of the old OBC, aka Options Boot Camp. My name, of course, Mark Longo from the optionsinsider.com. Your source for all your favorite options podcasts. Going back, man, over 19 years now. Next year, the big 2-0. What will the partay be? Will we force Dan to come down to the city? We shall find out next year on the big 2-0. And speaking of big things, if you weren't hanging out on the Pro this week, you missed a biggie. Vol Deathmatch 2.0. We had one last year, Vol Deathmatch 1.0. It was Dr. Vix versus the Vixologist. A lot of blood was shed, and a victor was crowned. And people have been asking us ever since, when are you going to do it again? When are you going to do it again? Well, we did it yesterday, man. It was a fun one. It was Scott Nations versus our good buddy Henry Schwartz, a.k.a. the Flowmaster, in a winner-take-all Vol battle with special guest referee Mr. Dr. Vix putting on the ref jersey there. It was a good time. There was a lot of blood shed. A lot of Vol talking was done. So if you are intrigued, the live is over, but you can catch it on the Pro podcast feed. And Dan, you know what? I'm in a given mood. To my knowledge, I don't think we've ever had any sort of discount on our Pro that we've been running it now for 5+ years, I do believe. But we were so excited for this Vol Deathmatch thing that we did give little discount to some of our newsletter and our email subscribers. And that has already expired. But you know what, Dan? I'm feeling given. I'm feeling charitable today. We like to give things away on the show. We give away Pro trading crates, all kinds of stuff. So I'm going to tell the folks to extend that code, which is Deathmatch. And you can get a month for 50% off. I mean, that's ridiculous. Again, this is literally the first time we've ever done any deal of any type, Dan. But we were so giddy to have another death match. I thought we have to celebrate. If not now, when, Dan? You know, exactly. It's, you know, for the low-hanging fruit people, you know, it's cliche to have like a Black Friday deal. So we pshaw all of that. We celebrate the death match. That's when we offer the savings to our audience. So if you've been on the fence about checking it out, theoptionsinsider.com/pro. There has literally never been a better time. Use that code Deathmatch. I know a lot of people did. It was a fun time out there, and you can still check it out. And of course, you get a dozen other live streams a week. You get 2 other exclusive shows. You get giveaways. You get true exclusives like the Vol Deathmatch, as well as the panel I did recently. All kinds of fun stuff. And again, the sweet giveaways that Dan's always giving away here on the show. theoptionsinsider.com/pro. You know, I got so excited, Dan, about the Vol Deathmatch. I'm still kind of giddy. As you can tell, I'm still kind of coming down. I'm wearing white now, but I would never have dared to wear white yesterday because there was too much blood flying fast and furious. There was body blows, there was haymakers, there was low blows. It was wild. There was accusations of skullduggery where the special guest referee was teaming up against one other person, so it was 2-on-1, which would be in true vintage pro wrestling style that the special guest referee would be a scumbag. That does sound about right. So yeah, there was a lot of that going on out there. But I got so excited, Dan, I neglected to introduce you. None other than the black-headed one himself, Mr. Daniel Robespierre Passarelli III, Esquire. I didn't know you had some French blood in you. Welcome back to the show, sir.
Savoir-faire is everywhere.
Yeah, Robespierre. I'm not sure the guy you want to be named after, Reign of Terror and all that fun. But hey, to each their own. Your parents obviously made some interesting choices when you were born. And you know what? We make some interesting choices on this show, listeners, whenever we go on into the options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to Options Drills. And, Dan and I have flirted with this topic a few times in the past. There have been some listener questions about it recently. Obviously, we've gone deep into this topic on previous episodes. We've been doing this show now for coming up on 13 years in March. So we have obviously touched on hedging many times. Go back into the archives if you want to check it out. But people love it whenever we throw in some of the real world costs of implementing some of these strategies and techniques. So we're going to do a little bit of that today, a little bit of a deeper dive into some of the real world costs of hedging and also some of the nuances therein. Dan, before I start busting out some of these numbers, I know this has been an interesting topic for you to mull over a lot of late as well. There's this standard textbook chapter 1. What are you going to use options for? You're reading your options 101 textbook, and chapter 1 is, hedging. You're long a stock, and for some reason you want to stay long it, but you're also maybe a little bit concerned. I think you could extrapolate that to the broad market right now as well. But you don't want to get out, so that's where the put comes in. It's, textbook options 101 use case. But we always say there's a lot more to it than that, Dan. When you're approaching hedging and some of the difficulties and nuances therein, how do you approach that with your mentees?
Well, a couple of ways. I guess the first thing that I do is ask them why are you even considering hedging? And if they're like, well, I think the stock is going to go down or whatever, they have some reason why they hate the stock. I ask them, well, why don't you just sell the stock? Start there, get the motivations right. But then I caution them about the value or the cost expense of puts. And then we kind of go from there.
They are not a free proposition. This is one of the first things people often bump up against when they come into options. They look at these like, I like the idea of staying long, but hedging. I could sleep at night. It's a great thing. And certainly it is. There is a use case for these. There is a value to these at the end of the day. Sometimes that value can be a little much for some folks. So we thought, a lot of people are talking right now about sell-offs in the S&P. They're uncomfortable with valuation levels, rotation out of large caps into something else. Pick your poison, international small caps, whatever it might be out there. For whatever reason, there's a lot of fixation on the valuation of the major indexes right now, which is a time that is tailor-made for some hedging, Dan. So right before the show, we pulled up some real-world numbers just to see, what is it costing you right now if you want to implement some of these strategies. When we came into the start of the show, Dan, the S&P hanging out 68.82. So that will be our at-the-money strike. So, there's a lot of different ways you can approach hedging. We just kind of carved it up very simply first. Let's go out straight 1 month in the S&P, Dan. And let's say you want to give yourself a little bit of wiggle room to the downside, but you want a decently tight hedge, all things considered. So you're going to cut yourself off at 670. So 670 and no farther. That's where you're stopping yourself out for 1 month. You're only going out 1 month. How much is that going to cost you right now, listeners? Well, the answer, again, SPY is 68.82, so 100 shares of SPY is going to cost you $68,800. $820 right now, which is no small outlay. That is larger than the full accounts of many of the new listeners of this program. But that said, if you had 100 shares of SPY burning a hole in your portfolio and you were worried about it and you wanted to hedge it right now, let's say $670 for 1 month. How much does that cost you? It's going to cost you exactly $7, Dan. That is the offer on the 670 put with 1 month to go. So obviously you do the math. That's 1% for a 1 month hedge, Dan, not counting, of course, the obviously 18 handles in SPY you would lose to drop to that 670 level as well. What are your thoughts about that as an outlay, sir?
Yeah, I mean, I always end up going to the classic insurance analogy where, you're protecting your put, the premium is the cost, but your deductible is the strike price. And so, like the 1%, wait, how many days till expiration you say again?
It's a 1 month put. We just went straight monthlies. We're not messing around in the weeklies.
Yeah. So, I mean, first of all, like you're on the hook, those 18 handles, that's 2.6% of the stock price. So, you're really sacrificing 3.6%. Just looking at the cost of the put as well, I mean, 1% to protect for a month, that's a 12% annualized cost.
Yeah, the ballpark, people always say the rule of thumb people always toss out there is 7 to 8% annually, which obviously lines up with your pretty much expected annual return for an index every year. Obviously, 12% exceeding that. So we're talking a little bit pricier. It is nice right now as we're doing the show. This lines up almost perfectly. It's almost exactly 1 month out, Dan. So people can see pretty much exactly what 1 month worth of hedging right now. And I should give you some other context as well. As we are coming into this show right now, vol is a little bit elevated compared to where it has been of late. We've been vacillating around mostly in a high 15s to 17 and a half range in VIX cash. Lately, we had a little bit of red on the screen last week. We're coming back from that now, but we are seeing VIX cash still elevated, still threatening a 20 handle. As we're kicking off the show, it's off about a point, but it was over 20 yesterday. It's at about a 1930 right now. So vol is somewhat elevated right now. So that will clearly weigh into our calculations here today. But that gives you, again, just some frame of reference. S&P 68.88 and VIX at right around a 1930. So factor that into your calculations as we're talking about these, Dan. But you know what? Now maybe 670, Dan, a little bit tight for your hedging. Maybe you think, you know what? I really am only worried about some sort of catastrophic meltdown, another tariff day tantrum, if you will, in the markets. So I'm going to stop myself out a little bit lower, save myself some of that outlay. So let's go down to, let's say, 650, 688 in SPY right now. We're going down to 650. So 38 handles. It's up to you whether you think that's a lot or not out there. The price for those right now, Dan, the 650 put, again, we're looking at a lot of round numbers, which is nice as well. It's pretty much exactly $4 right now. So that works out to pretty much about 0.5%. So again, you got $68,000 worth of SPY burning a hole in your back pocket. It's obviously going to cost you $400 to hedge it at the 650 handle. Again, not counting that 38 handles you're also going to give up. So Dan, what are your thoughts about a little bit farther out of the money hedging, and also your use case in general when you start putting on puts? How tight do you typically like to get? Are you going, the 670 and above, getting a little bit tighter, 6,800 maybe 68 half? Are you going, a little bit farther out of the money? How do you normally like to set it up? And what are your thoughts about shelling out $4 or 0.5% for a 1 month put?
I tend to go closer to the money. And I do that because I hedge very, very decisively. Like it might be twice a year that I'm buying puts, and I buy them for just periods of perceived risk. I buy extra time so the theta is low. and I end up selling them out. Definitely for a profit if they act as a hedge, but also if the stock doesn't go down at some point, I end up cutting bait on. So for that reason, I usually stay closer to the money, I think, than is often talked about by hedgers.
So you go farther out and meatier on the put side, sir. Let's explore that a little bit. Let's go a little bit farther out, shall we? I had a feeling you were going to say that, Mr. Robespierre. Let's go out 2 months now, which again, it lines up perfectly. We're heading into Feb expiration. So April expiration is almost exactly 2 months from now. Let's go to same strikes. Let's go 670. So you're kind of making a nice trade-off between tight protection and outlay there. Now you're talking 2 months worth of protection in SPY right now. That put is $11.09, Dan. So obviously $1,109 to outlay and buy a one lot against your 100 shares of SPY, which works out to about 1.6%. So now you're getting 2 months, 1.6%. And then, Dan, you talked about longer term. Let's go a little longer term as well, because that's, if I'm going to do it, that's usually kind of the way I would roll as well. Let's keep that same strike going just to have an apples to apples comparison. Let's go out to June now. So again, we're recording this coming into Feb expiration. We're going out to June, so we're talking 4 months now. That same strike, 670 puts, 18 handles out of the money, trading for 18 and a quarter right now, Dan. So going out to June, 2.6%. And if we go all the way out to the DEES right now, Dan, the DEES 670 puts, those are trading for $33.42. So you could go all the way out to the end of the year and put on a put that is in the ballpark of 5%. Now you have to factor in, of course, the 18 handles worth of downside as well. But maybe, I don't know, Dan, maybe you think that outlay is not that overwhelming for you. Maybe you like those D670 puts for $33. Is that where you would normally line up? Would you go out to the end of the year? Would you go out to June? And what are your thoughts about these vol and premium levels, sir?
No, I don't tend to go out that far. I don't know. I guess I'm more like something like 6 weeks to 2 months. And like, I want to go a little bit longer than, a couple weeks or a month to keep the theta low. But, the other side of the coin to theta is gamma. And I really, and that's why I go a little closer to the money, because I really want the gamma. I want to be able to buy an option at, some premium, but I want to see that delta expand and work for me once the hedge kicks in. So yeah, it's a real balance,
And I mentioned before that ballpark number you hear thrown around a lot, somewhere around 8% annualized to hedge yourself at a reasonable level for most of a year. And this, Dan, if you do the math, 670 strike, you're talking close to 5% for the outlay for these puts. Then, of course, you factor in the 18 handle drawdown, which is in the ballpark of 2.5%. Now you're talking in the neighborhood of about 7.5% is what it's going to cost you, which again, doesn't sound like a lot in these years, Dan, where we've been having double-digit returns every year in the S&P. People have gotten used to that. They might say, well, I'll shell out 7.5% to stop myself out at 670 throughout the rest of the year, and then I could sleep at night. But most years, Dan, your average equity return is somewhere in that 7 to 8% ballpark. So you've effectively given that all up at this point, Dan. What are your thoughts on shelling out that much for a DEES put?
Yeah, well, the problem with, here's another trade-off. The problem with the DEES puts is while theta doesn't hurt you as bad, it's delta that really becomes the concern when you go that far out, because that's a lot of time until expiration. I mean, if the market just goes up and you get your 8 or 10% a year or whatever. I mean, I guess got a month and a half gone. So, if it plays out how it typically does and the market goes up, you just end up losing more because they cost more. And you lose it on delta. So it's a tricky thing.
Now, obviously, listeners, there are ways you can offset that outlay. We talked about that many times on this network. We're just talking about the raw outlay right now. In that example, if you were going to do that, and Dan's right, the bang for that buck, it's obviously a lot of buck that you're shelling out for that put. The bang for it, though, obviously the delta is not as much, so you're not getting as much bang for that proverbial dollar out there. And there is a lot of dollars you're shelling out. So there are ways, of course, covered calls, you could write against it. You would obviously put those in the more nearer dated bucket. Maybe you would also do some near dated short puts to try to offset some of the longer term puts. There's a lot of ways you could play with that. Means you'd effectively be legging into short strangles against your long put. So you have to be okay and comfortable doing that. A lot of different ways you could do these things here, listeners, but that would over time chip away at this roughly 7.5% outlay. But I just wanted to put some real world numbers out there because we're always talking a lot of different theoretical things on this network right now. And then again, as you're listening to this down the road, this was Feb expiration in the year of our Lord 2026 with S&P a little bit shy of 6,900, VIX cash a little bit north of the 19 handle. And we're looking a few months out to the end of the year and what it would cost you to hedge a very basic SPY position. Now, Dan, there are other ways to hedge, of course. And this is where things also get a little bit interesting and equally expensive, perhaps, or maybe cheap, depending on your perspective. Dan, where do you fall on the age-old debate of the SPY or SPX put versus the VIX call? Because for a lot of people out there, they see vol upside as a portfolio hedge. Before I even get into some of the numbers, where do you fall on that age-old debate? Do you consider VIX to be a hedging instrument, sir?
I personally don't. But I do know that there are some smart people out there who do. And I think that they probably study it very, very carefully, specifically in the context of hedging. And maybe they developed some skill with it. So I'm not totally knocking it, but when the market and implied volatility have this indirect relationship, opposite relationship, and that only holds true 80% of the time. And it's not like the market goes up 2% and vol goes down, 2%. Like, it's very, very, very difficult to get a direct hedge, to get a hedge that gives you predictable results.
Yeah, that's why I've always bristled at the notion of calling VIX a hedge, because you're right, it's not. It is very much a speculative instrument. I've often referred to it as a kicker in your portfolio, something you can have in there that if vol really does explode, you've got this VIX upside in your back pocket. But as you point out, it is not one-to-one. You can't really go the direct delta. Oh, I buy this put in the S&P, it's a 50 delta. I know if I get this move in the S&P, this translates into this move in my put. That's a given. You can go to the bank on that in the S&P put. You can't do that in VIX for all the reasons you just laid out. It's a highly subjective move we get in VIX versus the S&P. And also, as we pointed out many times on our other show on the network recently, Dan, Volatility Views, it's become even harder lately. In fact, this is one of the topics that came up in our Vol Death match yesterday. It's almost a fool's errand at this point to buy VIX calls, unless, and I'll put this caveat out there, unless you're one of our hardcores, like, you're living in our pro chat, you're on your screens all day. If you're that in tune to the markets where you could see the VIX pop and you could effectively monetize your calls, or you were working at least part of your position with a limit offer to sell ahead of time, Those are the only two ways you can really effectively trade VIX upside now, because the quote unquote spikes that we're getting, outside of your, April 8th of last year and some of those aberrant events. And even that wasn't that long lived if you go check the numbers. But these spikes, Dan, are so short lived. I mean, we're talking, you don't even get a session anymore. You get a few hours if you're lucky to get that real apex of the vol move where you could come in, hit that bid, sell your VIX calls for whatever you want, 2x, 3x, 4x, whatever it might be. And then it's gone. And then next thing you know, if you're that guy with a day job and you got some VIX upside in your back pocket and you weren't working a limit order to sell it, guess what? You missed it. And your VIX calls are back to where they were. Maybe they're up a little bit if you're lucky, but you pretty much are just treading water, if not losing money again. And of course, every other month that you were buying these calls, you were losing money because it's a wasting trade until it isn't. So yeah, it's a challenging thing. I definitely would never refer to it as a hedge. I definitely lean the more direct route. If you are curious right now, listeners, if you are one of those people who says, you know what, I think of VIX as a hedge, what is it going to cost me? Well, let's run some numbers. Again, as I mentioned, normally the psychological level a lot of people fixate on when it comes to VIX upside is usually around that 20 handle. That's also makes a lot of sense when VIX is hanging out where it was, let's say a couple of weeks ago in the 15 to 17 range. 20 is usually a decent upside indicator that the game is afoot. Well, we were north of 20 just yesterday, so we're kind of in a little bit of an elevated regime out there right now. So I pulled some different numbers right now. If you want to go 1 month out in VIX right now, listeners, let's go up to the 25 strike, which is not usually my go-to strike. But again, when you're hanging out close to a 20 handle, you got to give yourself a little bit of room to run. That's going to cost you $1.25. So obviously $1,250 for a 10 lot if you wanted to go the 10 lot route. You probably wouldn't buy a 10 lot if you only had 100 shares of SPY. But that said, that's what a 10 lot would cost you out there. If you want to go the more psychologically important relevant level of the 20 handle, right now those are going for exactly 2.25. So $2,250 is what a 10 lot is going to run you in VIX land. And again, bear in mind, if you have these on, you need to be on your game. This is not a set it and forget it type trade. You need to be the guy who's running the real-time quotes on your desktop, or if you have a day job, you have access to real-time quotes throughout the day. If you're a surgeon in a 6-hour surgery, this is not the trade for you. If you're a teacher going in front of a class all day, this is not the trade for you. You really need to be glued to your screens out there. If you want to go a little bit farther out, listeners, let's go all the way out to April. So now we're going exactly 2 months. That's going to cost you $2 for that 25 handle. If you want the 20 handle, listeners, it's going to cost you $3.20 right now. So $3,200. Again, not inexpensive. You're also getting pretty much to the extent of how far out I would go buying VIX upside. Some people like to go a little bit farther out. I always think that's a fool's errand. I could see a use case for buying longer term puts in the S&P if maybe you are willing to adjust and roll and you also are doing some stuff to offset that outlay. But even then, going out a full year is not my favorite in the S&P. I would probably pick somewhere in that 4 to 6 month time frame. That's more of the sweet spot, and that's where a lot of the data that's been crunched on this tends to line up with the sweet spot between buying too much premium for your needs is usually around that 6 month ballpark. And then you can offset that pretty easily with selling premium. With vol, you don't even want to go that far out because the bang for your buck, the farther out you go, it falls off a cliff quite a bit. But that said, if you wanted to go farther out, let's go to June just for fun. The June 25s right now, $2.70, aka $2,700 for a 10 lot. So Mr. Dan, what are your thoughts on some of these outlays for VIX upside, A? B, the challenges of monetizing this in an effective way for the lion's share of the audience right now? And then C, what are your thoughts on longer term VIX upside? Do you think that's kind of a bit of a waste of time?
I don't, this is not a trade that I look at very much. So I'm just looking at it now and looking at a chart of VIX and, the volatility of the VIX. So the volatility is kind of high right now. And I'm looking at it, I'm wondering if it might, that really doesn't seem that expensive to me, $2. But
Dan's gonna roll the bone. Sounds like we got a trade going, Dan. Do I hear that little buzzer going off while we're talking now?
no, I would have to give this a lot more consideration. But, I mean, I look at the last year and I look at how many times it's been above 25. One time, which was a couple of sessions, another time, and then, of course, the craziness in April of last year. And then a little bit before that. I don't know. I mean, it looks like a reasonable trade to consider, but I don't know. I'm not. I'm just looking at it as a trade, not as a hedge. But
we're talking Dan into some VIX upside. He likes, if you're curious, listeners, he likes the 8.25 for $2. And again, there are ways you could defray that too. You could sell farther out of the money calls right now. The 30s going for about $1.40, so you could do that vertical, $5 vertical for roughly 60 cents. Something along those lines. Maybe if you wanted to, you feeling it, you could also sell the put to the downside to finance it. So there are ways to finance those outlays as well in VIX. But again, both Dan and I agree, VIX, not a hedge. It should be viewed as a speculative trade, or if you're viewing it in the context of a portfolio, more of a kicker. And again, only do this trade if you are living on your screens, because the days when the VIX trade was a bit of a set it and forget it trade are behind us. But you know what's not behind us? It's a little bit of your questions. Let's get there now. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, Senior P, let's get down to business. I noticed this in our live chat. This is another way people like to go about hedging. Not really an option-specific strategy, but again, a common one, and certainly one over the last year or so has worked out pretty freaking well. In fact, you could argue that the hedge is leading the dance in their portfolio right now. What are we talking about? We're talking about precious metals. We've got Mr. Unlimited in our chat saying, what about hedging with metals? Is gold a good enough hedge against the S&P? That way you're not always losing value in your put buys. So he brings up a point, if you're buying and shelling out premium for an S&P put, that is done with the understanding, Dan, that money is going away. You are sacrificing that money to the market gods. He says, what about taking that premium you're going to spend and spending that on an asset that theoretically shouldn't go away, like gold or precious metals? Obviously, last year, that was the best trade in town. If you bought gold or silver, your hedge, quote unquote, blew away your main trade. The best year in modern history for precious metals. I don't know if you can count on that. In fact, this year, we've obviously seen a lot of tumult. Silver selling off, 30% in one day? Gold selling off, I think it's back to about 4,500 now. So you might be feeling some pain on that. But Dan, what are your thoughts on, instead of allocating that premium to a wasting asset, maybe buying something else like a metal?
Well, I'm looking at a chart of SPY and a chart of gold, and they don't necessarily move opposite. Both of them were up pretty significantly last year. The April move of last year, let's see, gold went from 275 to 318. That's a pretty big percentage move. Yeah. So I don't know. I think you would want to do some sort of correlation measurement first, whether you use some actual real math behind it or just lay two charts on top of each other of each of them. And do they move in opposite directions? Do they move in the same direction? Or is it? So I don't know. I have become a lot more of a gold person over the last year, which I guess everybody has.
I think everyone has.
Yeah.
It's kind of hard. Inescapable, that trade was. Like I said, never talked in the 19-year history of this network. We've never talked about metals as much as we have in the last, let's say, 3 months. It's been just absolutely wild. Even your nemesis, Uncle Mike, the longest running silver bull I know, he exited at the end of last year, and he had a hell of a year. And he still missed out on doubling to the upside or tripling to the upside, whatever the hell happened since then. It's been a wild time out there. So yeah, I think everyone at the very least is cognizant of what's going on in the metals, even if maybe you're a little bit dubious about adding them to your portfolio. I know a lot of our listeners too, Dan, were getting lured into selling some of those put premiums, particularly in SLV, because they were astronomical. Triple digit vol levels in SLV is not something that really ever comes along. Now, you could argue it was merited when we had that 30% sell-off in one day. You could easily get your face ripped off on that. But that said, I know a lot of people were at the very least tempted. Some of our other chat, Dan, Option God says, the metals are just too expensive right now to consider as a hedge. And Nichols agrees with him, says, yeah, you can't really hedge with silver now in particular, too pricey. So that is definitely something to factor in. The cost of that hedge right now, definitely a little bit juicier than it was, let's say a year ago, Dan, when we were only on year 12 of this show. We were just in our infancy. Yeah. All right, let's get a few more questions here. We got some fun ones here. Let's go out. A lot of people have expiration on the brain right now. Maybe need to do a whole show on this, but let's go to Vince. Vince is first up. He says, what do terms like expiration and zero DTE even mean in a 24-hour trading world? Do they even apply? You know what? We got a very similar question here from ONTE08. So I'm just going to lump him in here with Mr. Vince. ONTE08 says, I am quite confused. I'm seeing headlines about new zero-day contracts, but also about 24/7 trading coming soon. Aren't these polar opposite things? How can you have a zero-day contract that trades 24/7? You know, they bring up something that I have been mentioning for a few years now, ever since the zero-day thing became the phenomenon that it has become. It does seem like we have two very contrasting movements in the market. One is they want a very finite exposure to the market. They want to be in and they want to be out and they want to get on with their day and they don't want to have to think about the market until the next day. And then there is clearly another audience that says, I want to never stop thinking about this market. It is kind of weird. These are the two biggest trends in the market, Dan, and I think our listeners are right. They are, in many ways, polar opposites. I don't think if you're a huge zero-day trader that you're really down for a 24/7 or maybe more realistically 24/5 market. You want that respite. You want to be able to plan your next day's trades and potentially sleep at night. But a lot of people, especially those coming from the crypto space, they want it on 24/7, Dan. So what are your thoughts on these seemingly polar opposite trends dominating the market right now, Dan?
Yeah, I mean, I've never really been a fan of the 24/7 or 24/5 whatever trade. I don't think it's beneficial. I think anybody who's ever had like an argument knows, like with your spouse or somebody you're close to, like everybody knows that when you're in the heat of it, the best thing to do is just go and take a little bit of a break because things can, balloon out of control. And with 24/7 market, I mean, you don't get that break. I mean, having a cool off period is very, very healthy. And I think, honestly, man, I think the only reason it's even being considered is because exchanges are now corporations that have to keep finding ways to squeeze more juice out of, and yeah, I don't know. I don't think I don't like it.
But Dan, you haven't lived until you've gotten an alert that your Shiba Inu is plummeting at 2 a.m. on your phone. then you're living well. That's a good time. Shiba Inu alert. Yeah, I do find this interesting. A lot of people I've talked to who do a lot of size zero-day trading, even on the institutional side, the main reason they point to that they're trading these products is because they are finite. And if you take that away, it's a very different game. So it will be interesting to see what these folks who are all hot and bothered now about Tesla and NVIDIA zero-day, are they going to trade them at 2 a.m.? Is it going to be a second 0 day? Is it going to be an evening 0 day? You're going to have the regular 0 day that expires at the normal closing time, and then the PM 0 day, Dan, that goes the rest of the clock. And who's going to trade those things? There's a lot of questions to be asked here, and I think Vince and Ante08 are onto something, pun intended. Let's go here to I like this handle, Old School Hollywood. So maybe we've got a Marlon Brando writing in here from beyond the grave. He says, I've heard Mark and Dan say multiple times that they used to avoid expiration like the plague as market makers. Why was that? And why was it something to be avoided? Well, Dan, I don't know about your experience, but I cut my teeth in the SPX, and we were trained very early on. You don't leave anything open going into expiration because that is just risk. So the final week, even sometimes a little earlier than that, when, again, it was only a monthly expiration cycle, you start planning to take things off. You start working spreads to either roll or close things out. If you find you have an 8 lot somewhere near at the money, you pester a broker near you till you can get, hey, can I take off 8? And they look at you like they want to punch you, but they say, okay, here's 8. And you close out that strike. And you're that guy. You're that annoying guy. But you want to make sure you have zeros all the way around the at the money heading into expiration, because that way, Dan, lies madness and risk and nothing but danger. That's at least the way all of us, I think, were trained. And yet now we all live in a nothing but 0 day world, which is kind of wild. Mr. Dan, did you have that same experience? And why were you taking stuff off? Or maybe you weren't. Maybe you were piling things on the last day.
No, I treated expiration the same way that you described. And I think that what's really important to understand or think about is that market makers don't act, they react. Like market makers don't say, oh, I want to go and buy these calls. They just say, here's my bid, here's my offer, buy it, sell it, do it, whatever you want, just trade on my market. And so because you don't actually choose to trade something, you run the risk of pin risk. The risk of pin risk is very, very high. If you don't stop trading things once the strike is flat on expiration day, then you could end up opening up some position and get pinned and losing money on some dumb trade where you're trying to make a penny and you come in long 10,000 deltas Monday morning.
Yeah, for a variety of reasons. It was just seen as naked risk. You forget about one strike, and the next thing you know, you get some crazy aberrant movement that no one was planning on. And as Dan points out, you come in the following Monday, and all of a sudden you got thousands of deltas that you didn't anticipate in the wrong direction, and it's coming back to bite you. So why even set yourself up for that? Take it off, which is why it's so wild to me that so many people now just live entirely in that bubble of danger. Of course, also back then, these systems weren't that adequate to really model a lot of this stuff. So you would roll in even on a professional system, and all of your Greeks were effectively meaningless the final few days of the expiration cycle. Your gamma was some infinite number that made no sense. Your theta was an infinite. It was just so you were kind of flying blind. So think of it from that perspective as well. You had no real viable analytics, and you had positions that were really only risk. Now, don't get me wrong. There were a few hardcore old school guys who would come in, and that was their one day to shine. They would come in, they would only trade expiration day, and they would try to buy stuff underwater, under parity, sell it over, and lock in some profits. You take a lot of risk doing that, but that was their way they liked to trade. So there were a handful of those guys. They were few and far between, certainly not like today, but still fascinating stuff. All right, Dan, we'll get out of here on this one from Tim Kramer with a K. He wants to know, what is more important when you are deciding whether to trade an option, volume or open interest? So Dan, you're looking at a strike, you see volume and open interest. Like, maybe where do you look first? Maybe that's a better question.
I mean, I always look at both, but I mean, I guess the question, hold on a second. I navigated away from the notes here. What's more important when you're deciding to trade an option? I mean, wait a minute. Did I just drop off the call? No, here I am.
Yep. I hear you.
Sorry. I'm assuming that this question relates to liquidity, because that, to me, that's the only reason to look at volume or open interest. And I mean, I guess open interest is more valuable there because, I mean, hey, if you're looking at it in the beginning of the day, there's no value. But what I think is important is that open interest is distributed. You know, if there's 20 strikes in a particular expiration and there's one strike that has 20,000 open interest and none of the other strikes have open interest, that's not liquid. You know, you want it to be spread around quite a bit and see that. So, I don't know, hopefully that question.
Yeah, at the end of the day, the spread's not going to lie. The spread is where I always look, and the spread will tell you if it's an active contract because the spread will be tight. And all that other stuff you're talking about there, the volume, the OI, that all feeds into that spread width at the end of the day. So you have to take all that and combine it in. And at the end of the day, if you see a nice tight spread on that option, you know that it trades fairly regularly. And if not, the spread at the end of the day, spread doesn't lie. The spread will take all that information and it will process it into a very wide or a very tight spread. That's the ultimate arbiter at the end of the day. All the other stuff is just inputs into the model. All right, Senior P, we did a lot of living on the show today. We talked about the real world cost of buying some SPY puts. We dabbled in the world of buying some VIX upside. Mr. P sounds like he's a little down for the Ape 25s in VIX land for $2. So I wouldn't be surprised if after the show I get a message saying I bought all those bad boys for $2. And then, of course, we talked a lot about expiration. You folks have a lot of expiration and very relevant expiration comments, if I do say so myself. We even talked about the metals, Dan. We did a lot of living on the show today. Did you have fun?
I did have fun. And yeah, man, we covered quite a swath of stuff, man. That was pretty crazy.
And we come in with one agenda, and then we always get derailed in fun ways by the comments and the questions and the listeners. That's what makes the show fun at the end of the day. And if folks want to have some fun with you, Senior P, where should they go? What should they do?
Oh, well, make your way on over to markettaker.com. 2 T's in a row, markettaker.com, and hit me up. I am there for you. I will be a resource to any options related thing, maybe even other things. I don't know. But yeah, that's where the
relationship counseling. He's there for you. You need a sponsor in AA. Dan's there for you. Whatever your needs are. Market Taker. Don't forget the second T for Theta. The Queen says she liked your comment about markets needing a cooling off period. She agrees with you, Mr. Dan. So there you go. I've always suspected the Queen may be Mama Passarelli, and that cements it. There we go. She likes Dan, so clearly no accounting for taste out there, listeners. And of course, if you want to check out something online, make sure you're checking out our friends over there at Tasty Trade, tastytrade.com/podcast. They and all the rest of our sponsors on the network are the reason we've been able to do this for you for now 19 plus years. So make sure you're checking them out. Tell them you found out about them on our network. It goes a long way towards keeping us there for the big 2-0. And of course, if you want to check out something very cool and unique, I guarantee you, no one else on the planet is doing a vol death match, let alone 2 of them. So get on over there to the pro, theoptionsinsider.com/pro, P-R-O. And I guess for the rest of this week, I'll be nice. We'll let it keep running. Our first ever real discount deathmatch. Use it all one word there. That will get you half off your first month if you want to try it out. Kick the tires and light the fires. Cost you not much at all, and then you can see all the stuff. It gives you access to over a dozen weekly live streams, 2 exclusive shows every week, a fun community, of course, your own podcast feed. You get access to all this cool stuff. Archives for days. Trust me, we've talked to just about every person you could think of. Pick the brains, I should say, of some of the best minds in the world of options and derivatives. And you folks have been steering the ship with your questions and comments. Of course, a lot of great unusual activity if you like that stuff as well. And hey, just for fun, we also give away some awesome stuff every month. theoptionsinsider.com/pro. Use that promo code deathmatch. And if you are hanging out in the pro, I'll be back in a few minutes in your ear holes with Miss Carly Garner. I haven't checked in with her in a little bit. A lot of wild stuff going on in the world of futures. We'll break it all down on the Futures Rundown. Then, of course, we're back at the end of the day to wrap it all up with a little bit of the old Thor Odinson, a.k.a. the Hot Options Report. Yet another reason why you should be subscribed to the full network. Then we're back again with the rest of our array of content throughout the week. Back with the Flow Master tomorrow. Back with Dr. Vix on Friday. Kicking things off with the Rock Lobster and Uncle Mike on Monday. Then we're back again next Education Wednesday. Another episode of Options Bootcamp. Stay safe out there, everybody.
Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.